For joining us. It's always a challenge being the last panel on the program, but I can promise you that we have a very impressive and stimulating group of panelists to take us through to the end of the program. So we are, our topic is a very general one, sort of looking at Dodd-Frank more broadly. But as we talked about this panel in planning it, we really thought it would be most productive and most useful if we would focus on parts of Dodd-Frank that had not been addressed in detail in previous panels. And as we thought about what we would address, it also seemed to fit nicely with the expertise that the panelists have, which really is to look at Titles 1 and 2 of Dodd-Frank, because Titles 1 and 2 obviously are very closely connected. Title 1 is the so-called enhanced prudential standards for systemically important financial institutions, the SIFIs, particularly sections 165 and 166. We're not going to really address at any length the idea of designating systemically important non-bank institutions under 113, but that certainly is a very important topic in its own right. But I think we're really going to be talking about, let's assume that we know, we've identified who both the bank SIFIs, of course, are those over 50 billion. Let's assume we have identified at least a group of systemically important non-bank financial institutions. How should these institutions be regulated to prevent a recurrence of a crisis similar to the financial crisis of 2007 to 2009? So we're going to look at Title 1, and particularly with the view of there's been a great deal of emphasis on enhanced capital requirements. Obviously, Basel sets up a system, at least it proposes a system where for the largest globally significant SIFIs, you would have total surcharges and buffers reaching up to 9.5% of Tier 1 risk-weighted capital ratio of 9.5% at the maximum, and a minimum leverage ratio of at least 3%. But more recently, in this country, there have been discussions about going beyond that. Obviously, the Brown-Vitter bill would go to a 15% equity ratio on a leverage basis for the largest SIFIs over 500 billion. And even short of Brown-Vitter, at least 3 members of the Federal Reserve Board, as I count them, Jeremy Stein, Dan Tarullo, and Janet Yellen have indicated in recent speeches that they see some possible need to go beyond the Basel capital requirements, although not specifying what that would mean. So one question is enhanced capital really the sort of the holy grail? Is that where we should focus our efforts under Title I, and how might that affect or link in with the other requirements, such as liquidity requirements, limitations on concentrated exposures, and so on. After we discuss that, we're going to move into Title II. And Title II obviously talks about the orderly liquidation authority that's established, the FDIC's attempt to set out a roadmap for that, most recently through this single point of entry concept. But then Title II, in a way, circles back to Title I, because now there's been discussion of, bail-in. How do you get bail-in treatment, and who should get the bail-in treatment? So looking at bondholders or subordinated debt holders, and once you start talking about capital structures for bail-in purposes, of course, it cycles back to Title I. So I think that there really is a close connection between the two areas. So I won't give you the detailed bios of our 4 panelists. Those are available in the materials. But I'm very pleased and privileged to identify them briefly. Going all the way down to my left, David Skeel at the University of Pennsylvania Law School. Larry White next to David at NYU. John Dearie at the Financial Services Forum. And next to me, Jim Barth from Auburn University. So we're delighted and honored to have them here. John is going to start us off with talking about Title I and enhanced prudential standards in capital.
Seems a bit formal to stand up in front of an intimate group, but I will anyway, because I have been told it will probably make it easier to hear. I'm very pleased to be here. Thank you, Paul, for organizing. As an 86 domer myself, I am very proud and pleased to see the university weighing in and contributing to these issues in such a meaningful way and for putting together this conference. I'm very pleased to be here. We are 3 years into the implementation of Dodd-Frank. A lot has been accomplished. A lot still has to be accomplished, as you all have probably seen in terms of the various reviews of Dodd-Frank. Davis Polk and others were only about 40% of the way there. But nevertheless, we're 3 years in, and so this is a really good, and we're about to celebrate, if that's the right word, the third anniversary of the signing, and so this is a terrific time to take stock of where we are, what's been accomplished, where do we go from here. In reading lots of the articles and commentaries, op-eds, papers that tend to come in a rush at the time of the anniversary of major pieces of legislation, it seems to me that there are really four principal criticisms of Dodd-Frank, at least at the moment. One is that Dodd-Frank is absurdly long and complex. Number two, related to number one, is it's just too damn difficult to implement, and that's the reason why we're only 40% in through the implementation 3 years after signing. I think the Volcker Rule is probably the most notable example of that, and I was just reading an article today about some comments made by SEC commissioners who described the Volcker Rule still as a jump ball among regulators. So we'll see when we finally see the final rule on that. Third, the Act was largely silent on a number of the causes of the crisis, and here I'm talking in particular about Fannie and Freddie. And then, of course, the Republican criticism of the Act, which is that not only did Dodd-Frank not address or solve some of the major causes of the financial crisis, and here, of course, we're talking about too big to fail, but rather institutionalized those problems. I think all of these criticisms have merit, all are deserving of discussion and debate, all have at least grains, if not a lot of truth to them. But taken together, these quite legitimate criticisms have contributed to, I think, both here in Washington certainly and around the country in the media, to a broader and deeper narrative that is unfortunate because it's not true. And that is that that broader narrative is that nothing has really happened since the crisis. Nothing has really changed. We're really no better off. There have been no meaningful improvements. Our banking system and our broader financial system is just as vulnerable to instability as it was in 2008. And that is certainly not true. A great deal of progress has been made since 2008. In fact, some very important changes have been made. A lot has been accomplished in the financial system. The banking system is far stronger and more resilient today than it was in 2008. For example, capital and liquidity are nearly twice the levels they were in 2009. According to the results of the Federal Reserve's latest stress test, that additional capital has raised the average ratio of Tier 1 common to risk-weighted assets for the 18 largest banking companies from about 5.5% to more than 11%. And as I mentioned, liquidity is nearly twice the level it was in 2009. Leverage has been reduced in some cases by half. Asset quality is far stronger. Balance sheets are far stronger, with problem loan balances and charge-offs being reduced quarter after quarter after quarter to levels not seen since before the crisis. Risk management, internal controls, corporate governance procedures have all been significantly enhanced, and compensation structures at most banks have been reformed to more closely align the personal incentives of bank executives with the long-term safety and soundness of the banks, in particular, specifically, very large portions of compensation being awarded in stock that doesn't vest for 5 years. So the whole idea is the bank had better be around in 5 years or you don't get paid. And then, of course, the clawback provisions of compensation packages. And we saw some of that following the London Whale incident. So together, these together with near record levels of capital, and in fact the FDIC, according to the FDIC, capital in the banking system is at or near record levels. You put that together with all these other improvements and you're talking about, I think, a much stronger and more resilient banking system and broader financial system. Now, responsible for these improvements, or responsibility for these improvements, lie with the industry that has taken the initiative and has made a lot of improvements. Very hard slogging work by the regulators, and Dodd-Frank. And in particular, I'm talking about Title I, as Art alluded to, and its regime of enhanced prudential supervision for the largest banking companies, imposing a much more onerous, detailed, and frequent regime of supervision on SIFIs. I know that we're going to be spending a lot of time today talking about Title II, its credibility, its workability, but I think that as part of that discussion, or any meaningful discussion of Title II, has to include, perhaps even begin with, a discussion of the importance and significance of Title I, because the whole point of Title I is to never get to Title II. In the context of Title I, there are some very, very important issues that are deserving of further scrutiny and discussion. And one, as Art alluded to, that I wanted to bring up, is the proper role of capital. Capital in recent months has emerged as not only a centrally important issue, but seemingly a silver bullet solution to virtually every supervisory challenge, whether those challenges be associated with large institutions or funding structures, wholesale deposits, et cetera. Every supervisory challenge that seems to come up, more capital is proposed as a solution. I am a former bank supervisor, so I certainly know and understand the importance of capital, but I also remember my supervisory training, which was that divorced from or considered apart from other equally relevant metrics of safety and soundness, the structure and quality of a bank's earnings, the nature and structure of its balance sheet, the reliability of its liquidity, the quality of its management, the rigor and effectiveness of risk management, internal controls, corporate governance, et cetera, a given level of capital really has very little supervisory meaning at all. So I do worry that this heightened focus on capital, capital is not something that is without cost or consequence, and in fact, there are certain circumstances, and perhaps we can touch on this later in the Q&A, the discussion that follows. There are certain circumstances where ever higher capital can even become perverse. It can actually incentivize greater risk-taking within the institution, which is certainly not the objective of the higher capital policy. But I conclude with the opening comment, and we only have 4 or 5 or so minutes to make opening comments, and so I thought it was important to start with the reality that great progress has been made since 2008. As we discussed Dodd-Frank, it's important, it seems to me, to keep that in mind and even base the discussion on that reality, not just because it's true, but because it's true, it has implications for identifying the issues that remain in terms of the implementation of Dodd-Frank and where we go from here. Thank you, Art.
Thank you, John. Now, since we have, well, we're all kind of veterans up here, but since we have 2 particular veterans of the crisis of the 1980s and early 1990s, and the role that capital and capital regulation played or did not play, or what we learned about capital and capital regulation from that crisis, I've asked Larry White first and then Jim Barth second to sort of comment on their views about what we did learn or should have learned from the crisis of the 80s and 90s about the virtues and perhaps shortcomings of capital regulation, and what those lessons might tell us for the implementation of Title I. Larry?
Okay, thank you. Let's see. Charlie, I'm the lowest tech guy in the room, but I figured it out. So, all right. Very pleased to be here. Paul, there you are. I like to hand out hard copy. Supply will greatly exceed demand here. So, just, you know, single page. Now, I need to put out two disclosures. The first one, because Todd Zywicki was one of the speakers this morning, I have to disclose I am not the Lawrence White who is Todd's colleague at George Mason University. That is Lawrence H. White, and if you want to learn about free banking in Scotland, he's the go-to guy. I am not he. As recently as Wednesday, I was in a congressional hearing up at the, as Frank knows, the Financial Services Committee, and another witness next to me leans over and literally says to me, gee, I really like your work on free banking. So that is not I. Okay. Second, the words Fannie Mae and Freddie Mac have come up a number of times already. They will briefly come up in my presentation, and so I have to remind you, for almost 3 years, from 1986 to 1989, I was one of the 3 board members of the Federal Home Loan Bank Board. In that capacity, I served as one of the 3 directors of Freddie Mac. When I left the Federal Home Loan Bank Board, leaving government service and returned happily to New York University, I also left the board of Freddie Mac. Since then, I have had 2 financial connections with Freddie and Fannie. In 1997, I was asked by Freddie to write an article for their publication, Secondary Mortgage Markets. I did so. I was paid $5,000 for it. It was published. I'm very happy. It was about bank capital requirements. You can find it on my resume. You can link on my website and find the article itself. I'll email it to you. If you have any trouble finding it, just send an email to me. I'm happy to send it to you. I was paid $5,000 for it. In the summer of 2004, I was asked by Fannie Mae to come in and give a talk to their advisory committee about bank capital requirements. They paid me $2,000 plus transportation expenses. I flew coach class shuttle from New York to Washington and back. I took street hail taxi cabs to and from both ends. Full disclosure. All right, in talking about these kinds of topics, the first thing one needs to remember is, of course, Warren Buffett's reminder that it's only when the tide goes out that you learn who's been swimming naked, and the tide in housing and our financial system started going out after the mid-year 2006, and within about 2 years we learned who had been swimming naked. The other, of course, is from the Washington-focused film, All the President's Men, of course, based on the book of the same title, but of course the classic piece of dialogue between Hal Holbrook, who is portraying the character Deep Throat, who's now known to be Mark Felt, who was the deputy FBI director at the time, and Bob Woodward, played by Robert Redford. Follow the money. So here we are, follow the money. All right, I'm a business school professor. I got to tell you what I'm going to say, then I'll say it, then I'll tell you what I said. First, remind you what are we really talking about too big to fail. Show you some pre-2008 examples. Then use the set of financial institutions that we really do know how to deal with, and that at the end of the day really weren't the problem in 2008. They came close to being the problem, but in the end they really weren't the problem, and that's depository institutions themselves. And what do we know about that? Then what can we learn so as to how to deal with too big to fail, and in conclusion. And Art, I think I'm sort of covering both Titles 1 and Title 2. All right, what's too big to fail? It's a large, obviously big, large financial institution. What do we mean by a financial institution? Well, as its assets, it holds primarily financial assets, and a lot of them, mostly, are illiquid. And what do we mean by well, a bank is certainly a financial institution. So is a bank holding company. So is an investment bank. The things we used to call investment banks. So would be AIG, including its holding company, GE Capital, etc. So that's what we mean Financial institution, it holds primarily financial assets. It has generally these things have thin capital, which means low net worth as a fraction of assets. And I'll show you how thin in just a minute. Those assets may be hard to value. Maybe the institution is insolvent. There's accounting issues embedded in here, and I will come back to that. Charlie hints at some of those in the written handout that he has. They generally tend to be short-funded. What do we mean by that? They have a significant fraction of short-term liabilities. What's the issue there? Fearful liability holders may run. But remember, the assets are illiquid. And just to remind you what a run looks like, just remember Jimmy Stewart in It's a Wonderful Life. That is what a run looks like. And remember how he has to tell those people, your money isn't here, I've lent it out. Illiquid assets, but short-term liability claimants. Okay, so what makes them so difficult a problem for failing? Either they are interconnected, which means that an insolvency can cause a cascade of other problems by other institutions that are creditors to this institution. That would be one version, a cascade. And then the other problem would be a contagion where you have other similarly situated institutions who look like this, and the fearful liability holders of those other institutions, imperfect information, asymmetric information, etc., saying, oh, if there's a problem in this one, maybe there's a problem in ours as well. Gee, we better get there before others do. Of course, that's a priority, issues of priority rules tied up here as well. So interconnected and or a contagion type problem. So, and runnable, all and thinly capitalized, and largely financial assets that tend to be illiquid. All those things, roll them all together, and large, above 50 billion at least, too big to fail. All right, so we've seen what a run looks like. Now, I want to really remind you what the world looked like on the eve of the crisis, December 31, 2007. These are the largest 15 financial institutions in the United States. We start with Citi. Now, Citi at the time is a $2.2 trillion financial institution. What isn't really brought out there is it's a $1.2 trillion depository institution with a $900 billion holding company up on top of that 1.2. And the holding company, of course, does have access to the Fed, but isn't covered by deposit insurance, and turns out to be very poorly prudentially regulated by the Fed, and has lots of those short-funded type arrangements that Matt talked about earlier embedded in. After that, Bank of America, JP Morgan Chase, and then number 4, Goldman Sachs, 3.8% capital. AIG, 9.0, but it doesn't really address the issue of that holding company that was issuing hundreds of $1 trillion of financial insurance. Morgan Stanley, 3.0. Merrill Lynch, 3.1. Both of them $1 trillion asset organizations. Then Fannie and Freddie, looking a little better, but what this leaves out is their guarantees that were twice the size of the assets, so that if you really look at what their effective capital relative to their obligations was, it was 75-to-1 leverage, not the mere 33-to-1 that something like this, or maybe 30-to-1, something like this. It was 75-to-1. Our lunch speaker said 1,000-to-1. Well, that may have been at the instant before they had to be taken into conservatorship. But as of the end of 2007, again, counting their guarantees, 75-to-1. Then Wachovia, Lehman, 3.3. Wells, MetLife, Prudential, Bear Stearns 3.0. So very large financial institutions, very thinly capitalized, and again, leverage ratios of 33 to 1 were not urban myth. They really did exist on the eve of the financial crisis. Okay, now, what do we know from basically an 80-year-old system for dealing with runnable financial institutions? Depositories. Well, a major innovation starting in 1933, federal deposit insurance. We've had deposit insurance since 1929, the state of New York. 1829, state of New York. But the state-run deposit insurance funds weren't really credible. It took federal deposit insurance. I put it first because it really did provide stability. If any of you have not been out to the FDIC training facility out in Arlington, I urge you, go out there. It's really great. Get yourself invited to a conference or something. You will see these black and white photos of people lined up outside banks, okay? And you look at them, and then you realize all of those photos are from the early 1930s. The women are wearing long dresses. The men are wearing straw hat boaters. We haven't had that kind of experience for banks since the early 30s. Why deposit insurance? To back up the deposit insurance, we've developed a, not perfect, but a pretty good system of prudential regulation. I put capital there first. Charlie, I'm sorry, I should have put in some form of subordinated debt or contingent capital as a major feature here. I'll come back to that in a minute. There are accounting issues wrapped up in how you measure capital. I'm a market value guy. Be happy to deal with the question of what to do when markets are things. Limitations on activities. If you can't put a capital requirement on something, then how can you possibly allow an entity to engage in it? But it needs to be a principled approach to when you want to put limitations on activities. Also, something else I left out, limits on loans to one borrower. There was a mention earlier of concentration of risk. Well, the banking guys figured it out a long time ago, limitations on the loans that any financial institution can make to a single borrower as a limitation, as well as general areas of concentration. Managerial competence requirements, close monitoring of the financial flows. You need a well-trained, well-paid, adequate numbers of examiners and supervisors to be enforcing all of this, and powers of receivership as a way to make things happen quickly and effectively with a pretty well understood rule book when this doesn't work. When you do, nevertheless, you have bank failures. Not perfect, but gee, it seems to work pretty well. All right, what lessons can we learn for then dealing with too big to fail institutions? First, these are not the depositories themselves. Remember, it's the bank holding company. It's the investment bank. It's a Fannie and Freddie, as it turns out. It's a GE Capital where deposit insurance is not an option. And I don't think we want to start expanding deposit or equivalent types of liability insurance to everybody in sight. But we do have this problem. How to reassure the short-term creditors of not only a target institution, an institution that may be insolvent, where the short-term creditors are starting to worry, will I get my money back? But you will also need some mechanism for reassuring the creditors at similar institutions because of contagion-type problems. And so you're going to need some form of, at the end of the day, prudential regulation. Now, because these institutions may not have access to the Fed, you're going to need a liquidity requirement. or access to the Fed. If they don't have it, you've got to have a liquidity requirement. You need enough long-term, and again, this comes back to what Charlie has in his handout, long-term, non-runnable, bail-inable loss-absorbing debt, whether you call it subordinated debt, whether you call it contingent capital, something that where you've got non-runnable liability holders who are going to be bearing some of the losses behind the equity holders. You're going to have to deal with the international aspects. I'm not very good at that. I don't fully understand that. The FDIC people will tell you, gee, we got it just about covered by just coming to an understanding with London. I hope they're right, but I don't really understand that. And then, you know, as I mentioned earlier, the FDIC has been working on this now for a couple of years. I heard a presentation about a year and a quarter ago on their orderly liquidation authority, which scared the hell out of me. That's a technical term. Because they understood how to deal with the target institution. They hadn't even thought about the similar institutions and the contagion problem. Fortunately, since then, they have, and they've basically come around to understanding this. I'm not sure they thoroughly understand it, but I think they're close enough that they now understand that it's not only the target, it's the similarly situated, and at the end of the day, you're going to need something like this. So, in conclusion, the too big to fail problem really is real, and it was at the heart of the financial crisis. I mean, it was those 5 large investment banks, it was the Citi holding company, it was the AIG holding company, and Fannie and Freddie. Those are the heart of the crisis of '08. The lessons from depositories are important. We need prudential regulation, capital requirements, but lots more as well. Right, the solution has to be a combination of the prudential regulation, liquidity requirements, and that very crucial bail-in long-term debt. I think the FDIC has been moving in a sensible direction. If you think that's not enough, if you think size is still a problem, then put I can't use this word here in Washington anymore, so put a fee on size tempered by capital size, tempered by riskiness, but put a fee on size if you think size is a problem, it's a negative externalities problem. And since Pigou in the 1920s, we've understood what's the best way to deal with an externalities problem. Put a tax on it. Shouldn't have put a fee on it. That's the way to deal with negative externalities. Thank you very much, Paul. Thank you.
Thank you, Larry. Jim, I think you're going to follow up on a number of these points.
Oh, all right, wait a minute. Let me get out of here, Jim.
Okay,
I'm
Larry.
trying to avoid the negative externality.
Yes. No contagion, right?
No, absolutely. Okay, and there's Skeel. All right.
You're down in that lower left-hand corner.
And now you find yours.
Thank you, Larry. Okay, it's a pleasure to be here. I look forward to any comments on anything that I say or the other panelists, or interacting with some of the other panelists. Thank you, Paul, giving the opportunity to talk about the Dodd-Frank Act. I am associated with the Milken Institute. Unlike Larry, I'm not going to disclose everything about me. I do a lot of expert witness work, so obviously I'm subject to confidentiality agreements. I did have an opportunity to work with Larry. You probably learned a little bit what it was like listening to him talk, okay? I always enjoyed what he has to say. I don't think there's too much of a disagreement with what he said, perhaps one area. And I would like to sort of mention a few things. First of all, Charlie took us back in history a little bit and said something about national banks not being involved in real estate, prohibited, in fact, for a number of years since their inception in the 1860s. It turns out at one time, if a national bank failed, that was prima facie evidence that the owners and managers of the bank had engaged in fraud. It also turns out that when you look at the savings loan industry in the late 1970s, there were risk-based capital requirements. There was a statutory capital requirement, and it turns out it didn't particularly work in large part because the Congress eliminated the statutory capital requirement and told the regulatory authority to determine what the capital requirement ought to be somewhere, they had to determine what it ought to be, and it was a range between 0 and 5%. Tells you a little bit about perhaps the political element. Now, let me just refer to 2 slides since we're asked to talk about the Dodd-Frank Act. It turns out here, Jamie Dimon was at a conference and he asked Ben Bernanke, the chairman of the Fed, a question. Has anyone bothered to study the cumulative effect of these regulatory and market fixes? And you can see Ben Bernanke's answer. And he has lots of comments, obviously, within the Federal Reserve System. The central bank doesn't have the quantitative tools to study the net impact of all the regulatory and market changes over the last 3 years. It's too complicated, which I think came on in some of the discussion earlier today and yesterday. It turns out not everybody, as we know, is convinced that the Dodd-Frank Act has solved the too-big-to-fail problem. 3 groups of individuals. As just a point in passing, Richard Fisher, as you probably know, is the president of the Federal Reserve Bank of Dallas. There are 520 banks in his district. 95% of those banks have assets less than $1 billion. There may be some sort of a reason why he's in favor of breaking up the big banks. Sheila Bair, too, has talked about breaking up the big banks. And Simon Johnson has gotten a lot of attention talking about breaking up the big banks, setting a cap on the size of big banks at roughly 2% of GDP. That's U.S. GDP. It's not the GDPs of all the countries in which the countries operated. Charlie's point about globalization of banking, should you look at GDP of the U.S. if you were to agree with him, or should you look at the GDPs of all the countries in which the banks operate? And I would recommend you, if you haven't seen it, the exchange between Simon Johnson and Charlie Galmerius with respect to what we should do about too-big-to-fail banks. What I'd like to do is focus, Charlie said this too, about the origins of the financial crisis. And in my view, the origin was really in the housing sector. It began to emerge more fully in the summer of 2007, spread then throughout the financial system, and that in turn led to the recession in December 2007, which ended in the summer of 2009. So it's a financial crisis, and I think a good part of the origin can be attributed to or placed in the housing sector based upon data, basically. You can see here the annual growth rate of real home prices over the last 120 years, and it turns out in 40% of those years, housing prices actually declined. They didn't go up. Okay, 60% of the years actually went up. So if you had a business model based upon the assumption that home prices only go up, obviously that was a flawed business model and led to problems. And home prices actually peaked, you can see, in 2006, the spring of 2006. The home ownership rate went to an all-time high, and that had a lot to do with a relaxation in lending standards, providing a greater ability for ever riskier buyers to get a mortgage to buy a home, construction, and everything related to the real estate sector, accounted for about 6% of GDP at its peak. I won't go into much more detail, but I think that's where we should focus, and you can see banks were holding approximately $4 trillion in real estate assets on their books. So obviously, everybody knew if indeed home prices would decline, which they did, that was going to cause problems for a lot of the banks, and obviously all securities backed by home mortgages. And you'll recall yesterday, Neil Karsip mentioned the 5 runs in the shadow banking sector. It turns out, I think, if you look at each of the 5 runs, a lot of those runs were associated with real estate-oriented collateral. So basically, you can attribute some of those runs to not just to a maturity mismatch, but a lot of the assets being tied or could be tied to the real estate sector. So I think that's important with respect to talking about doing things to deal with problems in the real estate sector, about which I don't have anything more to say right now. Larry talked about leverage. He looked at, I believe, his common equity. Okay. What I did here is looked at Citigroup based on a call that we had. Larry said he might say something about Citigroup. So I decided to go, and you can see this is the third quarter of 2008 before a lot of the big banks were bailed out. And its total assets were $2.1 trillion. I think Charlie mentioned, and a lot of people, Simon Johnson talks about the assets Citigroup being a lot larger than this. JP Morgan Chase doesn't have $2 trillion in assets. He says, and he's right in some sense, it has $4 trillion in assets. It's the biggest bank in the world. Using IFRS, if you're US GAAP, you get this particular number. Now, with respect to Basel III, I think the expectation is, and there are indications that Basel III is going to rely upon US GAAP. That is, they're going to net all the derivatives, not use gross derivatives, which would lead to bigger numbers, and obviously much more capital would have to be pumped into the banks. You can see if you use risk-weighted assets relative to Tier 1 capital, leverage ratio, it was 12. If you go total assets, common equity, it's 16, but if you use tangible assets, tangible common equity, it's 45%. Meaning a very small decline in assets would wipe out the capital of the banking institution. I think that's important, and I do agree with Tom Horning that one should look at tangible assets, not risk-based assets. Nobody paid any attention to risk-based assets. No investor, okay, during the financial crisis paid any attention to anything other than tangible assets, tangible equity capital, or market value. And they told you similar information. The correlation between tangible asset to capital ratio and the market value to asset ratio was very high. So either one with tangible equity. And Citigroup, as I mentioned yesterday, its tangible capital to asset ratio actually reached a low, based on reported data, of 0.5%. And that and the other bank, Bank of America, are two institutions. I was on a panel with a regulator, and he wouldn't name the banks, but he used the letters of them and said that those are the two banks were either at or near insolvency. I think we all knew that. Everybody did. It turns out that the bank holding companies, which I think is an important point, Simon Johnson spends a lot of time talking about JP Morgan Chase, Bank of America, Citigroup, and then you'll talk about Goldman Sachs, or you'll talk about Morgan Stanley as global financial institutions. And I would like to say more about the business models, and I'll mention one at the end with the last slide. And Wells Fargo doesn't really say too much about. Wells Fargo tended to weather the financial crisis without any real difficulties. It would be a domestic SIFI in contrast to a global SIFI, okay? And we have 8 or 9 global or SIFIs according to the regulatory committees, the Financial Stability Board. So you can see U.S. Bank Corp, PNC Financial, and that's $300 billion. And that's where Simon Johnson seems to say that banks were okay, we don't have to break them up. $300 billion, roughly 2% of GDP, okay, depending on when you measure GDP. And Wells Fargo had, when it failed, $300 billion in assets. As you know, it was still a bigger bank, acquired, obviously, I said...
Wachovia.
Washington Mutual.
Right.
Washington Mutual. Okay, it was Washington Mutual. Wachovia is interesting because there are tax breaks given to the acquirer Wachovia in a short period of time, and they were taken away. And it was a decision made solely by the Internal Revenue Department with the approval of the Department of Treasury. That it turns out that Washington Mutual, with $300 billion in assets, was indeed the cutoff point based on what Simon Johnson would say. I agree with, I think, a lot of people, not everyone obviously, that the breaking up the banks is not the way to go. And I would, again, refer you to what Charlie Cameron had to say in his debate with Simon Johnson. Totally arbitrary. Oh, the other point I wanted to make, if you look at these institutions, okay, what's interesting about Citigroup, if not the others, and let me just look at the numbers here, it turns out that Citigroup, in the holding company, which is sort of important, has $600 billion in assets as of the third quarter of 2008. And Larry had a larger number going back earlier, $900 billion. Okay, so they reduced the size of the holding company. if you look at Bank of America, it's $500 billion just in the holding company. And if you look at JP Morgan Chase, it's $350 billion. My point is that's where there is a problem, okay, depending on how the assets are funded. And that would be the bridge bank, supposedly, that we're talking about, on the federal FDIC's point of entry, okay, is to basically seize the holding company and use a lot of the liabilities of the holding company basically to absorb all the losses, with the exception of short-term debt. It turns out, I've always wondered why the holding company structure was really needed, so I just sort of asked the question. Historically, we know why, in some sense, to move across to states, those sorts of things. But in addition, if you look at IndyMac Inc., okay, in IndyMac Bank, about 99% of all the assets of IndyMac Inc. are basically the banking institution, okay, that is the FDIC-insured subsidiary institutions. And there was a legal suit, and the question was over whether or not IndyMac Inc. should have been a source of strength for IndyMac, the bank itself. And it turns out here, the bank directors also were being sued for having thrown good money after bad, the holding company actually putting money into the bank, IndyMac Bank. And it turns out under the law at the time, it turns out for a savings loan holding company, there was no requirement that the holding company be a source of strength for the subsidiary bank. Okay, only for the Federal Reserve was that the case. So it is interesting as to why it is we needed a holding company. We need holding companies, and almost all the assets are basic assets of the subsidiary FDIC-insured institutions. Was it a way, basically, to delay the seizure of the holding company through the bankruptcy procedure, because the regulators couldn't seize the holding company prior to the Dodd-Frank Act? And was that a delaying tactic to take more money out of the bank, continue paying dividends, and so on and so forth? Again, sort of an interesting question. If 99 or 90% of all, 99 or 98% of all the assets are FDIC-insured institutions, why did we really need a holding company at some point in time, apart from what I mentioned, like going across state lines and doing sorts of things? If you look at the investment banks, and I think Larry pointed out, very highly leveraged, okay? And this is just tangible assets, common equity, not tangible common equity. So you can see what decline, obviously, in the value of the assets would wipe out the institutions and make them insolvent. Again, that goes back in time and compares 2005 to 2007, sort of what Larry was doing before the financial crisis started to fully emerge in the summer 2007. You can see they were all fairly highly leveraged, and with the exception of Goldman Sachs, over that 2-year period, they became a bit more highly leveraged. Now, what hasn't been said yet by most of the participants in the conference, except for our speaker last night, and indeed our luncheon speaker, it turns out that I have done some work with Ross Levine at Berkeley and Jerry Caprio at Williams College, and basically we have a book out, MIT Press book in 2012, and what we do, and it's been done by others, I suspect, in different sort of contexts, point out that the regulatory authorities basically, I'm not sure I'd say failed miserably, but they did indeed fail to fulfill the responsibilities in regulating and supervising the institutions. You can see here, we heard a lot about credit default swaps. It turns out the Federal Reserve allowed banks to reduce capital via credit default swaps. And AIG, as we have heard too, basically was involved in a lot of those credit default swaps. And it turns out the FDIC didn't bother at all to worry about the financial condition of AIG. And it turns out that contributed to the leverage of the institutions, Citigroup among others that I already mentioned. In 2004, SEC says it would provide consolidated supervision, but it didn't provide the capacity to supervise. And you can see here, when you look at the Inspector General of SEC, incidentally, I don't want to be too harsh on the regulatories, but reasonably fair. And I don't name individuals, unlike Gretchen last night. I've never mentioned anybody where I worked, the Federal Home Loan Bank Board or the Office of Supervision. I think agencies, I'm talking about, not individuals, and a lot of, when you go down, you do find there's a lot of evidence provided by institutions themselves, basically, that there were problems, they were identified, and nothing was done to deal with those problems. In 1991, we had the prompt corrective action provisions of Fdic, okay, legally obliging FDIC to act as capital was deteriorating, common equity in particular. So again, the FDIC, and I agree with this wholeheartedly, excellent at identifying problems, identified what caused 79% of the banks to fail years before they actually failed. And that was true, incidentally, if you go back in the 80s and look at the savings loan institutions. FDIC's own material loss reviews note that 95% of the time, the FDIC did not act promptly and correctly to address known problems. I think that is a real problem. It raises some questions about how do we get the regulatory authorities to enforce the existing laws, to do what they're obliged to do to protect the taxpayers. A major point, I could go into extreme detail about some other countries and about the history of the United States. There's not time. But if you look historically, I go back to 1790, but if you look historically, and you look at every major financial law in the United States since 1790 to the present, I just have 1860 to the present, and you look at every one of those laws, which laws were enacted after a financial crisis and which were enacted before a financial crisis to prevent or mitigate the outcome of a financial crisis. Most of them were enacted after a financial crisis. So what do we get? More laws, more regulations, and indeed we got more regulatory authorities as well. Ending most recently with the Dodd-Frank Act of 2010. There are a few of the laws that were enacted basically in response to changing market forces and an acknowledgement that basically the laws ought to be changed, not because of a crisis, just because banks were adapting in a more modern environment and changing their business models. Another point that Charlie was making, business models can change over time, and they're different among different banks. I think we have to recognize that when we regulate institutions. Here's our regulatory structure. I don't think everything's on this slide. It turns out we have one new agency, which was talked about yesterday, Consumer Financial Protection Agency, and we basically have one agency that was eliminated, where I had been associated, the Office of Supervision, which did a particularly lousy job regulating its institutions, asked last night why there was an incentive perhaps to grant forbearance against big institutions like Countrywide, Indy Mac, and Washington Mutual. Part of the reason is that these institutions paid the OTS, were levied fees basically, to run the OTS. And those three institutions, I believe, are accounting for 40% of all the fees that the OTS kept. So it didn't want to lose any institutions. And at Countrywide, just a sidelight, Countrywide had a commercial banks which converted to a savings loan institution to be regulated by OTS, basically, and was trying to do everything they could to put all of its mortgages onto the books of the Savings Loan Association. They just didn't have enough time to do it before the institution basically was acquired. So again, we don't need probably this particular regulatory structure. I could make a few more comments, but I won't. This has to do with Congress. You think of chairmen of different committees. Do you want to eliminate basically certain types of regulatory bodies, certain types of institutions? Perhaps then you eliminate a congressional committee. The chairperson or ranking members perhaps get less in fees when they are in contributions or when they run for office. So there's probably a barrier to trying to consolidate our regulatory system. We wouldn't have this particular structure if we start over. What Jerry Capri and Ross Levine and I do is we think we have to impose more discipline on the regulatory authorities. We have to hold them more accountable, and we propose a sentinel. I won't say too much about it. It's in the book. And we want it not to have any regulatory powers whatsoever. And last night, an interesting question was asked when Gretchen mentioned Gerald Dokow, who Larry and I know personally, though we haven't had anything to do with him for years, said, what was the incentive for Gerald Dokow to do what he did, to backdate documents Well, you have to say, a regulatory authority is deliberately setting out to not enforce existing laws and regulations. So we came up with the notion that we need a sentinel, which is sort of an unbiased referee. So the analogy we had was from a book written by a University of Chicago professor and a Sports Illustrated writer who basically pointed out that referees, over time in all types of different sports, tend to be biased in favor of the home team. And so to eliminate or reduce that bias, we have instant replay, just so you can question what the referee did and the decision perhaps might be reversed. Well, what we came up with the analogy, the regulators don't have an incentive to be evil, do bad things, but perhaps they're biased, not unlike referees in sports events. What's the home team? They're regulated institutions. What's the away team? The public, basically. So they'd be biased in favor of making decisions in favor of the regulated institutions. I won't say too much more about it. Obviously, it's a controversial position. The last thing I'll say is perhaps what we should have done is allowed non-financial firms, which nobody's touched on, own banks. We have 9 banks, FDA-insured institutions, that are owned by non-financial firms. Larry mentioned GE Capital. Okay, GE owns a bank already. Walmart wanted to acquire a bank. Probably most of you know that. When you look at them, Harley-Davidson owns a bank. Why? Somebody comes in with black leather outfit with big boots, says, I want a loan to buy a motorcycle. What does the loan officer say? Sure, I'll make you a loan. Harley-Davidson believed it could provide more loans to motorcycle buyers, and those motorcycles they believed they could value, and they knew their collateral value if indeed they had to seize the motorcycle because of non-payment. CMS Energy, you can see Target Corporation, Toyota, Flying J, if you see them, you drive along the highways. Not a single industrial loan corporation, and they go back to the early 1900s, has ever failed in the history of this country. Okay, but look at, what we did is look at the ILC assets as a percentage of its parent's assets. Relatively small. If I showed you percentage of their equity, of the parent's equity, very small. So as a Toyota executive told me, Jim, why in the world would we ever let ILC fail? Okay, it would hurt the reputation of the parent, so the parent he told me, imposes more discipline on the ILC than the regulatory authorities. They hold it to stricter standards than regulatory. And if you go worldwide, China allows non-financial firms to own banks. There are only 4 other countries out of 126 that prohibit non-financial firms to own banks. This is a result of moratorium. I'll stop there.
Thank you, Jim. Dave is going to talk to us about Board of Liquidation Authority and maybe some possible bankruptcy alternatives to the OLA.
That's a pretty good guess.
Are we finding convergence or are we finding divergence? I guess
I think what we're finding is confusion. Not that other people are confused. I'm confused, I think.
Go all the way over to the left.
All the way to the left.
And there you go.
And I'll rely on the technical expert, Larry.
I'm the lowest tech guy in the room, I assure you.
So I think I could challenge you on that. So I thought I would start out my couple of minutes of talking in a very creative way by thanking Paul for inviting me to this conference, which makes me about the 15th person, but it really has been a fabulous conference, and so the thanks are heartfelt. I, at this point, am sort of overwhelmed by the problems and complexities that we've talked about over the last couple of days. I'm sort of depressed about all of this. I mean, my takeaway at this point is that the few things we're pretty sure would work as a practical matter and could make things better are politically impossible. The things that are politically impossible, Charlie told us and others have told us less directly, are not, it's not at all clear that they'll work. So I'm just going to say that. And then from here on, I'm going to talk as if I do know what I'm talking about and I'm not confused. But I should start by acknowledging I am. This is my head is spinning at this point in our 2 days together. So what I'm going to do is very quickly 3 things. I'm going to talk about bankruptcy, financial distress, Title II of OLA kind of stuff. So very quickly, I'm going to talk about the ostensible origins of Title II, just to point out something I can never resist pointing out, which is the intellectual fraud, to use a charged term, on which OLA was based. Not that OLA is bad, but the case for it was quite dubious, in my view. Second, talk about the FDIC's single point of entry. And I think I'll start out the second point by just very briefly describing Title II and the orderly liquidation authority, the resolution rules. I thought by this point in the panel somebody would have stopped and given the details. I'll give a 30-second version of the details. I'll talk about the FDIC's proposed approach, which they call single point of entry, and some of its virtues and vices, in my view. And then talk about bankruptcy as an alternative to it, and what I'll refer to as Chapter 14.2. A group of folks at Hoover, of whom I am one. They don't pay me to do this. Maybe they might have paid me for a conference or something. What they do is they pay my expenses, coach, to fly out to Stanford every few months, and I jump on that plane as fast as I can. But Chapter 14 is a set of proposed changes to the bankruptcy laws, in many respects relatively small, to make it more effective for large financial institutions. It is aimed at financial institutions with at least $100 billion in assets. So those are the 3 things I'm going to do very quickly. First, where did the resolution idea come from? Well, the argument was the FDIC has done a fabulous job of resolving banks for 75 years. What we need to do is simply do with big institutions what the FDIC does with everybody else. All sounds really nice. It was repeated over and over. People at the FDIC still repeat this. It is, in my view, pretty close to fraudulent for this reason. Everybody knows that well, first of all, that there weren't resolutions for most of that 75 years because banks weren't failing. When they did start to fail, the FDIC did an okay but not great job. The FDIC got better after the changes that followed the S&L crisis and prompt corrective action. They're still not perfect. They do an okay job with those banks, but those banks are completely different from the financial institutions that we're talking about. The FDIC model is they talk with potential buyers of the bank. They choose a buyer secretly. They come in on Friday afternoon. They close the bank down. They transfer the deposits and the assets to the buyer. And on Monday morning, everything opens up business as usual. This would be offensive to us in the sense that the FDIC has complete discretion how to do this. There are almost no limitations on what they can do. This would be quite offensive, except that the government is the real party in interest in these bank resolutions because they're 96% deposits, the liabilities. So it really is the government stepping in and deciding what to do ultimately on behalf of taxpayers with these small bank resolutions. So from that perspective, what the FDIC does, the complete discretion they have, is, I think, defensible for small and medium-sized banks, but it has nothing to do with the big financial institutions we've been talking about for the last 2 days. You can't resolve those in 3 days. The single point of entry would have a quick initial part to it, but it's not going to resolve these things in 3 days. Government-insured liabilities are a much, much smaller part of the balance sheet, so there are real creditors, non-taxpayer guaranteed creditors with these large financial institutions. The FDIC's strategy creates a damned if I do, damned if I don't risk. If you're really trying to find a buyer, sell a giant institution over a weekend, it may be you can't find a buyer for that institution, in which case it doesn't work. The other possibility is you do find a buyer. In 2008, it was usually JP Morgan Chase, and what you do is you make a big bank even bigger. So We may like OLA. We might like the resolution rules. I don't like the rules the way they're written. I actually like them better the way the FDIC is talking about implementing them. But it has nothing to do with the way the FDIC resolves other financial institutions. So if I don't achieve anything else in my scholarly life, if we could end this argument, I would be happy, because it makes me red in the face whenever I hear it. I won't name names since we're not naming. I was sitting behind some of the folks who were making this argument at a hearing about a year ago, and I wanted to go like that, but I didn't, because CNN was watching. Actually, let me tell you briefly what the orderly resolution rules, orderly liquidation authority, the resolution rules, the way they work. The idea is a resolution is implemented when the so-called three keys turn. The three keys are the main bank regulators, the Fed, the Treasury, and the FDIC. Each has to agree that we need to take over this financial institution and that there's a risk of adverse systemic effects if we don't take it over. If the regulators decide to take the institution over, they file a petition at the federal trial level court here in Washington, D.C. There is a secret hearing. The court has 24 hours to decide whether to allow this takeover or not. The only grounds for not allowing the takeover at this secret hearing are that it's not actually a financial company, that the bank regulators, oops, they mistook a bank for General Motors, or that the institution is not in default or in danger of default. Now, you tell me how many institutions that the three bank regulators want to take over are not, as a result of that very move, in danger of default. So there's no way to counter the takeover. Very quick 24-hour period for the judge to decide. Once the takeover occurs, the FDIC is put in place as a receiver. There is a requirement that managers who are responsible for the failure, and responsible is the term of art, have to be kicked out. Shareholders are supposed to take losses. Creditors are supposed to take losses. And there are a lot of provisions borrowed from bankruptcy for the purposes of OLA, although the reality is the FDIC can do whatever they want to do. And if anybody wants to get into the details of that, I'm happy to explain why the FDIC has complete discretion in these things. But what the FDIC has done in conversation with the big banks and with the law firms that are representing them is devise this approach that's called single point of entry. The way single point of entry works, and I also thought this might be described by now, it has been briefly described, I'll describe it again. The way single point of entry works is it's aimed all at the holding company level, at the parent company level. The idea is when the FDIC takes over the institution, they're just going to take over, in most cases, ideally, they're just going to take over the holding company. So this is why it's called single point of entry. The point of entry is at the holding company level. They're going to transfer all of the assets, all of the long-term liabilities, and secured liabilities as well, to a new bridge institution. They're going to leave behind the shareholders and the long-term unsecured debt. And the long-term unsecured debt is primarily going to be bond debt. And the idea is we'll have this really quick recapitalization where it'll actually take a few months to sort it all out, but the initial move will be very quick. And as a result of the move, we will be leaving shareholders behind. They will likely end up getting nothing. The long-term debt that's left behind will be written down, is the idea. No, we're not sure how much they'll be written down, but they will be written down. Short-term debt will be protected. So it's a very creative use of the resolution rules. I actually like it. I think there's some problems with it. I think it's not clear it will work. But I think it's quite clever, and I think it's possible that it could work. Virtues of this approach, one is that it is a quick, surgical solution as long as there are not disasters at the subsidiary level. If there are huge disasters in the subsidiaries, this is going to be a lot harder to pull off, but it's quick and surgical. Another virtue is it fits the structure of U.S. banks. This is something Jim was alluding to with the fact that U.S. holding companies have major long-term debt in them. It's very unusual as a worldwide matter. It is an artifact, the whole structure of the holding company with lots of subsidiaries, the holding company with long-term debt in it is a historical accident. And it may be this is one of those rare cases where the unintended consequences of the history of the limitations historically on branching of banks, the unintended consequences of that are to make something like this possible in the US, where it's going to be much more difficult in Europe. Europe's trying to implement similar ideas, but the capital structure of banks is a lot less conducive. Financial institutions is a lot less conducive. Another virtue is the FDIC, although they've got complete discretion, they are at least signaling what they plan to do. They are saying, we are going to write down the long-term debt, we're going to protect the short-term debt. The market might not completely believe them, but at least the FDIC is signaling and creating a presumption of what they'll do if, in fact, they ever take over one of these institutions. So what's not to like about this? One is it's going to require more regulation, because if you were a bank and your long-term debt might be written down, it's going to get a little bit more expensive, and so you're not going to want to use that kind of debt. And so there's going to have to be another rule to require you to keep that debt in there that you had before. This whole thing isn't going to work. Question, which Art raised with me over lunch, is who's going to hold these bonds? If other too-big-to-fail institutions hold these bonds, it could reinforce the unwillingness to use the write-down. So there is a question of who ends up holding the bonds. Another concern about this is the concern that worries me the most, is we're basically taking a world where we provided too much protection, too much priority to short-term debt, derivatives, repos, and the like, and we're saying we didn't give them enough protection, let's give them some more. Let's give some folks more incentive to use short-term debt. You know, we didn't have enough of that in 2008. That bothers me a lot in this approach. In fact, that's probably my single biggest concern. As I've already mentioned, this doesn't address problems at subsidiaries. There's ways to try to deal with that, but this approach works best if you can just do the quick write-down at the parent company level, and you don't have to worry about subsidiaries all over the world. Another concern about this is, although under Dodd-Frank, there is a rule that says cross-default provisions are not enforceable, so the failure of the parent can't be used as a basis for default on a derivative in a subsidiary. That works in the US, doesn't work in London, so there's an issue of whether that'll be a problem. This whole strategy violates one of the key principles of Dodd-Frank resolution, which was we're going to liquidate these institutions. Barbara Boxer put language late in the legislative process in just to make sure you've got to liquidate these institutions. Really idiotic language in my view, but it is language that's in the statute. What are we doing? This is a reorganization. This is the way we've done reorganization in the US for 150 years. This is the way we did reorganization with a little government help and manipulation in General Motors and Chrysler. Another concern is the concern that we have through all of this, and that is, will anybody ever pull this trigger? You know, if we have another crisis, will they just bail them out all over again? I suspect that if you have more than one institution in trouble, they will, and that this won't change that. Very quickly, the big banks have made an argument that this ends too big to fail, and it solves all of our problems. In my view, this doesn't end too big to fail at all. Not clear whether the FDIC is going to use this when push comes to shove. And even if this were used the way it's laid out, we're not changing the concentration in the financial services industry. What we end up with is a big institution after the resolution, just like we had a big institution before the resolution. This is one reason, in my view, that folks like J.P. Morgan love this idea. And they contributed to this idea because it doesn't rock the boat as much as they were afraid the boat was going to be rocked. Very quickly on the bankruptcy alternative, Chapter 14, a bunch of proposals to the bankruptcy laws this Hoover Group proposed a couple of years ago. The current action here is a discussion about replicating the single point of entry kind of approach in bankruptcy. I believe you can do it. If you think this is a good approach, I think you can do the same thing without using Dodd-Frank. The way you would do it is you would do the transfer the same way as in a single point of entry transfer, sale of assets, transfer of most of the debt to a newly created institution in bankruptcy, and you leave the old stock behind, you leave the long-term debt behind if that's what you want to do. The provision, 363, the bankruptcy sale provision, it was misused in my view, in Chrysler and General Motors, could be used to do this. There are a couple of difficulties, a couple obstacles to making this work. One is that we currently do not have any stay on derivatives in bankruptcy. The rule that creditors cannot cancel contracts, they can't grab collateral, they can't sell collateral that they have, that applies to all creditors except QFCs, derivatives, repos, and folks of that sort. Dodd-Frank has a one-day stay for derivatives. I think at the very least that ought to be applied in bankruptcy. I also think there needs to be a Dodd-Frank-like provision that invalidates cross defaults for this to work. The $64,000 question in bankruptcy is liquidity. Could you do this without the enormous amount of liquidity that the FDIC has access to in Dodd-Frank? Not clear that you could. There's an argument that when you do the sale, the new institution would be really well capitalized, could borrow money from private markets really quickly. I'm not sure if that's fast enough. And so the big issue right now is, do you add a liquidity source? Should it be from the Treasury or the Fed discount window? If I had to choose one, I guess I'd choose the Fed discount window, but this is a tricky issue because whenever you add the liquidity, you add the possibility it will be misused, and it will be used to bail out rather than to resolve. So by way of conclusion, although I've been a critic of a lot of this stuff throughout the process, I do think the single point of entry strategy is a very interesting strategy. I don't think it ends too big to fail, but I do think it is better than what Dodd-Frank actually says. But I'd be much happier if we made a few changes to bankruptcy and reinforced the idea that bankruptcy is the option of first resort when one of these things is in trouble, which is written all through Dodd-Frank, is we're going to use bankruptcy unless we absolutely can.
Thank you. Well, I think David has illuminated to me three really important and significant problems with either the Title II OLA as in the latest iteration of the single point of entry. And by the way, two very interesting sources I think that are very useful. One is a speech given by Paul Tucker, the Deputy Governor of the Bank of England, on May 20th, in which he goes through the single point of entry at great length and speaks optimistically. And for a much more pessimistic view, Simon Johnson has an economics New York Times blog on May 16th called "The Myth of a Perfect Orderly Liquidation Authority for Big Banks," which is basically attacking the single point of entry as being any answer to the basic problem of too big to fail. So you can look at those as bookends. But the three problems I think David has highlighted, which I think I very much share, is one, are we essentially either with a single point of entry Title II version or the version 14.2 of bankruptcy, are we basically going to accelerate the rush for institutions, particularly in strain or trouble, to run towards short-term financing, because only the short-term creditors, the QFCs under 360 days, will have any likelihood of 100% treatment. So that we're going to have sort of Lehman Bear Stearns on steroids when the next problem comes. Linked to that is sort of who's going to buy the bail-in bonds, right? If bail-in, and I agree with Larry, bail-in bonds become the critical component of making the single point of entry work, because you got to have something to write down. So the question is, who's going to buy them, and how much you're going to have to offer them in yield for them to buy, and particularly, are there some people you don't want to buy them? Because it seems to me if you let SIFIs buy them, you end up with the AIG problem, that everybody goes down together because they're all linked together. And the third problem is where are you going to get debtor in possession financing? Now, Title II tells you where you're going to get debtor in possession financing, which is the U.S. Treasury. The U.S. Treasury will provide a 5-year loan that can be extended for, I think, another 3 years at least, if not 5. So the U.S. Treasury is a debtor in possession financing, which to me makes Title II an enormous opportunity for bailouts. But if you went to the bankruptcy alternative, I think David has pointed out just right, how are you going to get debtor possession financing in a so-called private bailout process? So with those three questions, I would invite panelists, particularly those who, other than David, because I think David's given us sort of his views already, to sort of weigh in on those three questions.
All right. Short-term, will this lead to a rush to short-term financing? Yes, of course, and that's why you need a regulatory requirement that specifies there's enough bail-inable long-term debt to handle the fears of the short-term creditors. So yes, and that's why you need.
So very hard.
There's just there's no avoiding that. That's a negative externality problem, and that seems to be the way to deal with it. Who will buy the bail-in bonds? You can't let SIFIs buy in. It has to be held as part of diversified portfolios by pension funds and hedge funds and mutual funds, and it's got to be held in diversified portfolios. The DIP financing, it's clearly an issue, and I just don't know.
I would add to what Larry said. I agree with everything he said. The Fed is already talking about imposing a minimum for long-term debt, and we've already read, I think, in the news reports that Wells Fargo is opposed to some sort of minimum that's obviously would be too high. So the Fed would have to impose a minimum. Then the question does become who would actually buy it. I assume the Fed won't buy it, okay?
Let's hope.
Let's hope not.
It's buying a lot of other debt, okay? But presumably it won't buy it if others refuse to. One other quick comment I meant to mention about capital. We've heard proposals of capital requirements, 20, 30%, 15% Brown-Vitter. I might point out that Modigliani and Miller theorem is used by some to suggest that one can substitute equity for debt. The debt cost goes down if the equity cost goes up, and they cancel one another. You may not know it, but Modigliani and Miller are on two sides of the same issue. Miller basically took the view that that is indeed possible, a debt for equity, equity for debt swap, but it turns out Franco Modigliani filed an amicus brief in a case and basically argued that that's wrong, that increase is indeed costly, okay, and you don't get a sort of a one-for-one exchange in terms of one cost going up, the other going down. So the two disagreed, and as you know, Modigliani and Miller shared the Nobel Prize in part for that theorem.
John, did you want to comment?
Yeah, just two quick thoughts. I think that Dave, I agree, David, as you did last week. I was at another conference last week, and David gave a similar presentation on his critique of OLA and his advocacy of bankruptcy, and a point that was made there, and it was made by Mike Kriminger, formerly of FDIC, and I think it's pretty much correct that the kind, although I'm sure that David has a response to this, and I can't remember if you had time to respond at that conference, David, but the observation was that the kinds of changes to bankruptcy that you're talking about to make it more workable and appropriate for large financial institutions, in a certain sense, that bankruptcy begins to look more and more like OLA in a certain sense. Moreover, what seems to be a major, or perhaps even the major critique of OLA is the discretion that FDIC has. You made the point earlier, and somebody on that panel made the point. You know, the FDIC has become increasingly specific, at least in terms of what they say that they're going to do. Now, your point as to whether or not they really do that is well taken. But to the extent that one of the, the daylight between bankruptcy and OLA is FDIC discretion. The FDIC has complete control over being more specific, and as they become more specific about how they intend to pursue a single point of entry, that will hopefully allay that problem. So you've got this kind of convergence. There are ways that OLA and bankruptcy can actually move in the direction of each other, and hopefully we arrive at a workable and credible system.
Can I say something?
Sure, go ahead. Sure, absolutely.
I'm going to answer and run, so you can shoot me in the back. If you'd like. And that is, I agree with you completely that there is a convergence going on, and I think that is a good thing.
Yeah.
On all sorts of different levels, not least of which is if you've got differences between the two systems, substantive differences, you'll have a gaming of those differences.
That's right.
And one of those examples is stay, no stay in bankruptcy. The other is they're not exactly the same. I mean, you still have the difference
Sure.
in bankruptcy that you have the managers and the creditors making the principal decisions rather than regulators. Even those differences are being collapsed a little bit, but at the end of the day, the trigger is likely to be the managers of the company in bankruptcy, whereas it's regulators in OLA. Thank you.
Cheers. My second comment was, and it's too bad he has to leave because he may have a response, is on the topic of DIP financing. That is a major issue, and while I understand the objections of the FDIC's way of financing as part of OLA. The two alternatives that David presented for the way that DIP financing could be arranged in a bankruptcy, either financing directly from Treasury, or the thing that really sends the shiver down my spine is by way of the discount window. That to me is a very bad idea. It has been a concern of mine for a long time that too many people continue to see what is legitimate, and I think you made this point in your presentation about the purpose and the objective and the reasonableness, the importance of having access to a lender of last resort. The discount window is not a backdoor bailout. I don't think it should be thought of that way. But if the window got involved in providing DIP financing, you're getting awfully close to that flame. And that would bother me a lot. So again, I find myself caught in between. You know, I understand the objections to OLA, but I see the operational difficulties associated with bankruptcy.
I just want to emphasize two things that sometimes get lost here. And I mentioned it briefly in my presentation, but I really want to drive the point home. There are two issues here. One is how to, in a lot of the financing stuff, how to deal with the institution that is teetering. But second is the contagion issue. And if you think about 2008, Lehman went into bankruptcy, and if you talk to the guys at the New York Fed, you just, can see their eyes, going back to what, remember Lehman did it on a Monday morning, and by Monday afternoon, and then Tuesday morning, they have visions of, grass starting to grow in the streets again, and the ATMs not working, just the entire financial system falling apart because they see a run developing on Merrill, basically, and they're worried that then it will hit Morgan Stanley and then even Goldman. And the contagion issue is something that that needs to be kept in mind, as well as the how do you deal with the immediate teetering. The other is the I'm not a lawyer. I would never think to practice law without a license. But what I'll call the perceived arbitrary and capriciousness of the FDIC in the way it handles its receiverships. And back in the day when Jim and I were at the Federal Home Loan Bank Board, of course, we still had a separate deposit insurance operation, the FSLIC, the Federal Savings and Loan Insurance Corporation, which basically was doing things the way the FDIC did. And my initial impression walking in from the outside, not being a lawyer, I was quite surprised at how arbitrary and capricious this whole receivership arrangement seemed to be. After a while, I got used to it, and basically, in thinking about it again 25 years later, gee, you get a bank charter or or a savings and loan charter, you know, you've signed up for the whole package, which may include going into a receivership and whatever the FDIC brings along with that. I can sort of see how GE Capital thinking to itself, well, gee, we don't have a bank charter. We didn't sign up for this FDIC arbitrary and capriciousness, but we're just going to, my feeling is, one, they're not all that arbitrary and capricious. They do have this rule book, and it will become more specific, which lays out what generally they're going to do. And I don't, unless there can be this very quick bankruptcy procedure, and we've got this assurance for all the similarly situated institutions and their short-term creditors so that contagion is dealt with, I don't see any good alternatives.
Well, I think the contagion point's, to me, very fundamental, because what we've seen in virtually every major financial crisis is that you don't have just one major financial institution, as you say, teetering or stumbling along the cliff edge. You've got several, some are closer than others. And Continental Illinois was certainly bailed out because Paul Volcker and others believed that if they didn't bail out that one, that Manufacturers Hanover was going to go. They didn't bail out Manufacturers Hanover, Chase was going to go. They were all lined up in those days.
Right, long-term capital management in 1998. It's a cascade problem. It's not a contagion. It's a cascade problem that they were worried about there. One or the other, you've got this multiple instance.
So David's point, I think it remains salient. I think this is true with bankruptcy, too. Will the regulators pull the trigger on the first one? Because if the first OLA does not go perfectly, if there's any sort of disruption or disappointment of creditors, that would spread very quickly. And so I think that's a great question. Would the regulators, even with all these tools that they've laid out, pull the trigger, or would they be, in fact, more tempted to do what they did in 2008, which is to do sort of an open bank recapitalization?
Well, after pulling the trigger on Lehman, and in less than 24 hours,
they regretted
realized,
it, right.
Oh my God.
Right. AIG was bailed. The one thing I agree with Barney Frank is that he said after we bailed out AIG that free market, that market discipline lasted 24 hours, he said. We let Lehman go, and then 24 hours later we bailed out AIG. I turn to our chairman. I don't know if we have any time for questions or not, but I...
Time for maybe about 2 questions.
Okay. Yeah, we are.
And please address your question to particular panelists if you'd like.
I got one. For Jim. You mentioned oversight, the need for oversight of regulators. I think you called it Sentinel. Just to me, the natural oversight of financial regulators is academic research. I think better access to data from regulators is something we can all support here. So.
Yeah, as Lord Kelvin would say, if you can't measure it, you can't improve upon it, which I think is a good quote. We use it in one of our earlier books. It turns out the Sentinel is a very controversial proposition. We don't say it solves all problems, but it's meant to be an independent agency consisting of experts. And it would have the imprimatur of the Congress basically setting it up and the president. And it would have a voice that I think most people would pay attention to. It could go before the Congress twice a year, not unlike the Fed does, in terms of going before the House and the Senate, and basically raise any issues where there are disagreements between the Sentinel and what it is the regulatory authorities are doing. The problem with being an academic is no matter how good you are and how much evidence you have, very few people pay attention to you. Okay, just a little bit of Larry, a little bit of history. In the 1980s, late 1980s, I wrote a piece with the deputy chief economist at the Federal Home Loan Bank Board saying the Fdic was insolvent, which Larry mentioned. I was uniformly denounced by the chairman of the agency, before Larry got there, incidentally, the chairman of the agency and the ranking majority member of the Senate Banking Committee and the ranking minority member of the Senate Banking Committee denounced us as being wild-eyed academics who had no touch with reality. We said the Fdic was insolvent by a certain dollar amount, which was picked up in the Washington Post and went to other newspapers. It turns out there's an attempt to fire the deputy chief economist who's reminded there are civil service requirements that prevent you from summarily firing somebody. I was a visiting scholar and just simply told, go back to George Washington University. It turns out that within a few months, the chairman testified and didn't reference what we had done, which incidentally went through the channels and was approved by the agency to be released as a working paper, and then said basically, and this relates to that watchdog question, like that whistleblower question, he then said that the Fdic was indeed insolvent, and he differed from our number by 0.2 billion, okay? So again, that's the advantage of a Sentinel or being within an agency, issuing a paper before anybody actually reads it at the top levels, pointing out problems. But if it has people read your paper, it may never see the light of day. So academics have a problem talking, I think, to media and convincing them there's a serious problem. You remember John Polson owns a hedge fund, made a few $1 billion betting that home prices would decline. He went to the regulatory authorities and told them all his concerns about a decline in home prices. Nobody particularly paid attention to him. It was fairly obvious when home prices are going up at 10% a year, year in and year out, that eventually Bill Gates cannot afford to buy a home. So we knew home prices had to stabilize and then go back down, and they did. They plummeted fairly substantially. If banks are holding, and this was looking at individual banks, but looking across the system, if banks were holding $4 trillion in real estate loans and home prices go down, you knew there would be problems apart from other securities backed by mortgages. So that was fairly obvious. There's some disagreement from earlier, was it nobody really knew? Did people know? Who would pay attention? There were people out there, including one of the governors, Lyle Gramley. There was some conference at Freddie Mac pointing out problems in the housing sector, subprime mortgage, liar loans, ninja loans, all those sorts of things. But again, no one at the regulatory authorities paid particular, or Congress. Who has the expertise? Well, a lot of it's buried within the Federal Reserve System. And they tend to have, as you know, a monopoly of information, and Bloomberg and others had to sue basically to find out who was getting money under the TARP program and other programs. And a U.S. federal district court judge, she said basically it will not do irreparable harm to the American economy if that information is released. So think about it. The Fed did not want to release certain information. It took a federal district court judge a ruling to get the information.
Jim, would it be an unfair characterization to describe your Sentinel as an expanded Inspector General, IG concept?
In a way, but an Inspector General doesn't have all the expertise that we're talking about in a separate independent agency, and there are some reports.
So a bunch of IGs then.
Yeah, and not a GAO, which more widely covering many different areas of expertise.
One more question, if any? If not, please join me in thanking the panel for a very stimulating presentation.